The key to our success, or the key to our fortune, has been to consolidate the entirety of a historic mining district, a district that was famous in the late 1800s to produce over 8 million ounces of gold and almost 200 million ounces of silver. So it's quite robust in terms of the geology, a strong production history on a 2-mile strike, which we have now extended and defined to be over 6 miles long. Most recently, we've done some fantastic drilling to develop out a significant resource in our first 2 target areas, and over the last 3 years, we've completed 2.5 years of full production. So we're producing now at a good low-cost structure, and we produce over 10 ounces of silver for every ounce of gold. For the first 9 or 10 years, we were consolidating the land and developing out the resource. Our first pour of production was at the end of 2012, with 2013 being our first full year of production. In the last 4 quarters, we've had positive cash flow from operations, and we've effectively built out the infrastructure. So we're very keen now to develop and grow the first mine, which is in the Lucerne area, and commission the second mine just south of the Lucerne in what we call the Dayton area. So by 2016, we'd like to have 2 mines in production, growing revenue at a very good cost structure. I think that we're surprised at the magnitude of the consolidation. So today we have 10 square miles, over 8,000 acres, with a 6-mile mineralized strike zone. So we're very excited about that. I think that we have substantially all of the property position put together. Our resource only is a small fraction of our first 2 target areas, and we have 7 high-grade target areas over the entire district. So I expect to see significant expansion of our resource over the next few years as we start our drilling programs again. Really, we haven't drilled since the end of 2012 when we commenced production, so we're very excited now to start expanding that resource and expanding that those ounces in the ground. Yeah, certainly. So we have all series of economic shells for our mines. We have scenarios where we can mine at as low as $900. At $1,100, we're very comfortable. At $1,000, we're comfortable. Probably we'd like to see higher gold prices to have more reinvestment economics. So what we like is we built a flexible system that as the gold price moves up, we can ramp up. If the gold price moves down, we can be more conservative with our assets, yet still maintain profitability. We're bullish on gold, of course. We feel very strong about the longer term for gold, but in the short term, we like to have a certain amount of our book priced, so we have certainty for the next couple of months, and then we look out further and we'll put some puts to protect the floor. So we like to have predictability in the near term and downside protection in these kinds of turbulent times. But we're bullish overall on the gold price, and we look to, as you say, leverage that rising gold price as it comes.